then the impact of the fallout of the Credit Suisse turmoil, what the outlook is for global markets, as well as where India stands with Rajesh Kothari, CIO at AlfAccurate Advisors. Thank you so much for taking time out, and I just want to get in a sense as to what your outlook is as to how one should really read into the situation amid this acute volatility. Clearly now, investors will be raising a lot of questions when it comes to the global financial system and in terms of a lot more regulatory pressure perhaps on these corporations down the line. Is that going to be on top of mind?
Well, I think I think you started with the absolutely very right question, and undoubtedly there is a global uncertainty, a little bit more volatility. But I think the biggest lesson I think the regulators have also learned in last 20 years or so, particularly post Lehman collapse, is to be agile and to act fast. So if you look at SB financial crisis, before market opened up in Asia, US Fed came out and they supported not only the depositor, but they gave a solution to the full economy that set an example, correct? And same thing yesterday happened even for, Credit Suisse Bank, whereby, the new lenders came in support of Credit Suisse. So I think the world has become, agile because there are two important factors, social media and of course the sentiments, and both need to be addressed in the right way. Otherwise it can create chaos. And that's good news, from the equity investors' perspective, because it basically helps to contain the crisis to the specific case rather than allowing it, and to make it a contagion effect. And I think that's basically a good thing. And that's why if you look at the global market, despite these two crises, the US markets are not going down. I think, therefore, one needs to give a little bit more time kind of thing, needs to have a little bit longer time horizon. And in fact, if you ask my personal view, we have opened our mid and small cap PMS, which was closed for inflows because market is corrected handsomely. The valuations have also now corrected. We are getting mid cap index and small cap index at almost probably less than last 10 years average valuations. And in India on ground, the economic growth is remain rock solid. The story is still good. Look at GST collection, look at fuel consumption, look at any macro parameter. I think as in India, we are doing reasonably well. And I think it's provide good opportunity. That's why, in fact, we opened up our AAA budding list mid and small cap offering again for open for inflows because I think it is a good entry point for investors at current level.
Okay. What do you think is now going to be the approach, or what should be the approach for a lot of investors at the current juncture as we're making sense of all that's taking place globally? Do you think that there is now going to be a tilt towards perhaps safer havens for investment?
Undoubtedly, I think when you say safer havens, it all boils down to what kind of quality you are buying. You need to make sure that the companies what you have bought, they are resilient. They are fundamentally, of course, very strong. They have the best of the risk management practices. And of course, as a investment house, what we believe in diversification to make sure that if there is any shock, you should be able to absorb that shock. So the companies need to be agile enough. Their risk management practices needs to be, of course, strong because the world is changing very fast. And you need to make sure that you don't get hit unnecessarily from macro or micro factors. And therefore, definitely there will be premium for the quality because world has learned that, there is nothing that you can predict. So even the top 4 auditor firms who have audited CS or SVB, and in matter of days, what has happened. So it is extremely difficult to predict such events. Make sure that you don't get hit unnecessarily from such global events.
Do right now, Rajesh? Book out from all the profits that you're sitting on, or buy the dip already?
I think, as a house, we are very agile. If required, book the profit, and if required, buy at dips. So that strategy varies from company to company, stock to stock. Our view on the company and their earnings growth over the next 12, 24, 36 months. And, that's what mantra, what we always believe in. Remain agile, remain nimble. If required, exit the stocks where you think that probably things may not work as per what would have thought 1 year back. So discipline exit strategy is critical.
I'm sure it is. So give us a glimpse into the agility. What is it that you've been selling? What is it that you've bought already?
Difficult to talk stock specific, but on a macro level, I can tell you we have been bullish on capital goods as a theme. and that is working very well. Banking is another theme on which we are positive. Of course, you need to be very, very selective when you buy the banking stocks. Pharma, we have been avoiding almost from last 2.5 years, post October 2020 on lockdown of COVID. We are avoiding pharma. IT is the one sector which we have been underweight since last about 12 months, and our view remains the same. So broadly, these are the basically, our sectoral call from the portfolio perspective.
Just appreciate your time. So glad you could join us. Now, what do we have in the market?